You know, there is this pervasive narrative in the investing world about consumer staples.
Oh, absolutely. The whole safe and boring angle.
Right, exactly. The companies that make the stuff sitting in your bathroom cabinet or, under your kitchen sink. The conventional wisdom is that these companies are, well, they're safe, they're slow, and frankly, they're just boring.
Yeah, you buy them when you're terrified of the broader market.
Right. You hide in them, you collect your 2 or 3% dividend, and you expect absolutely zero surprises.
Yeah.
I mean, it's supposed to be the financial equivalent of watching paint dry.
People always need laundry detergent, right?
Exactly. So they will always buy laundry detergent.
Yeah.
That's the fundamental premise you and I, and really most retail investors, operate under.
And, it is the ultimate defensive playbook, or at least it used to be. For a long time, that reputation was completely earned.
Right.
If you looked at the landscape of consumer packaged goods, or CPG, over the last few decades, it was characterized by this glacial single-digit growth.
Yeah, just inching along.
You rarely saw wild swings in market share. It was it was basically a war of inches fought over end cap displays at the local grocery store. Mm-hmm. But the macroeconomic realities of 2026, they have completely shattered that illusion of safety.
Oh, totally.
We are currently operating in an environment where the consumer is demonstrably strapped. Inflation has fundamentally reset all the baseline costs. And, well, the old playbooks simply aren't working anymore.
Which is exactly why we are dedicating today's deep dive to a company that seems to be, completely ignoring that memo.
They really are.
We are putting on our Talk Tickers hats today for you, the retail investor, because our mission today is to break down the Q2 2026 earnings call for Church & Dwight.
A fascinating call.
Truly. And, if you don't know the corporate name, you definitely know the ticker symbol, which is CHD,
yeah.
And you absolutely know their brands.
Right. Arm & Hammer, OxiClean.
Yeah. Arm & Hammer, OxiClean, TheraBreath, Batiste, Hero, all of them. And our goal today is to basically cut through the Wall Street jargon, bypass the corporate fluff, and deliver a data-forward, highly opinionated, and actionable analysis of this specific quarter.
Because it demands it.
It does. Because when you read this transcript, it does not read like a boring, sweepy soap company. It reads like an aggressive, highly optimized machine that's going to war against some of the biggest international rivals on the planet.
Yeah. Honestly, it is a masterclass in operational execution because, as we just established, the deck is heavily stacked against consumer companies right now.
Heavily.
We are seeing massive legacy brands struggling to just maintain their sales volume without completely eroding their pricing power. They are trapped between a rock and a hard place.
Yeah, it's like a lose-lose scenario for most of them.
Exactly. Either you lower your prices to keep your customers, which just destroys your profit margins, or you keep your prices high, you preserve your margins, but you have to watch your actual customer base shrink.
Right. But Church & Dwight, they seem to have found a third path here. Okay, let's unpack this. Let's get right into the data, because the headline numbers they reported, they initially look a little deceiving.
They do.
If you just glance at the top line press release, you see that net sales for the quarter increased by 1.6%. And I have to admit, when I first saw that 1.6% figure, my immediate reaction was, well, okay, there's that boring beige consumer staple growth we were just talking about.
Right. It doesn't exactly get the blood pumping.
No. It doesn't make you want to jump out of your chair and call your broker to initiate a massive position.
No. On the surface, it looks incredibly anemic. But this is exactly why we have to look under the hood of these earnings reports and specifically look at how CPG companies manage their portfolios.
Exactly.
That 1.6%, that's what is legally referred to as the reported sales figure.
Right, the raw number.
Yeah, it is the raw, unadjusted total of money that came in the door compared to the exact same period last year. But the number that analysts and institutional investors actually care about, the one you should care about, is the organic sales figure.
And this is where it gets crazy.
Yeah. Church & Dwight's organic sales jumped a massive 5.8%.
Wow.
And to put that in context, management's own internal outlook for organic sales was only 3%. So they didn't just beat their guidance, they nearly doubled it.
So, okay, let's unpack the mechanics of that gap, because I think a lot of retail investors get tripped up on this. How do you reconcile a 1.6% reported growth rate with a 5.8% organic growth rate? Where's that missing 4.2%?
It's a great question.
In the transcript, I noticed the CFO, Lee McChesney, he specifically referenced, quote, 2025 business exits.
Right. And this goes to the very heart of corporate portfolio management. Large consumer companies, they are not static entities. They're constantly buying new brands and critically selling off old ones. So when McChesney talks about business exits, he means divestitures. Sometime in 2025, Church and Dwight looked at their portfolio and identified certain brands that were, either underperforming, dragging down overall margins, or maybe just no longer fit their strategic vision for the future.
So they just got rid of them.
Right. They sold them.
They trimmed the fat.
Exactly. They trimmed the fat. But, and this is the mechanical part, when you sell a brand, you also lose the revenue that brand was generating.
Oh, right. Because it's literally not in the building anymore.
Precisely. So when we look at that reported 1.6% growth, that number is artificially dragged down because the 2026 version of Church and Dwight is operating with a physically smaller total portfolio of brands than the 2025 version was.
Okay, that makes total sense.
Right.
They are missing the revenue from the brands they sold.
Exactly. Organic sales, however, that's a metric designed to strip out all the noise of acquisitions and divestitures. It isolates the variables. It asks a very specific question, basically. If we only look at the exact same brands that we own both last year and this year, how are those specific brands performing?
And the answer to that question is that the core ongoing business is growing at nearly 6%, which is just a phenomenal acceleration for a mature staples company.
It really is.
But, the part of the underlying data that I found genuinely staggering is the actual composition of that 5.8% organic growth.
What's fascinating here is how they achieved it. Yeah.
Because in the retail sector, organic growth is pretty much always made up of two distinct levers, right?
Yeah.
You have volume and you have price/mix.
Right.
Church and Dwight reported that their 5.8% organic growth consisted of 4.3% positive volume and just 1.5% positive price mix.
That ratio is the defining metric of this entire earnings call.
It's wild.
It is. And to understand why that is so remarkable, we have to look at the macroeconomic context of the last 3 years. Mm-hmm. I mean, in a high inflation environment, the entire consumer packaged goods industry has basically been running a single unified playbook.
Jack up the prices.
Exactly. Jack up the prices. We have seen it across the board, from cereal to deodorant. Companies report, 5 or 6% revenue growth and Wall Street cheers. But when you dig into their specific volume and price mix ratios, you realize their volumes are actually down like 4%.
Yeah, and they just raised their prices by 10% to cover the difference.
Right.
So they are selling fewer physical items, but they're charging so much more for them that the top line revenue looks like it is still expanding.
Precisely. And just to define terms here, price mix essentially means you are either outright raising the retail price of your product, or you are manipulating the mix by selling a higher proportion of your premium, more expensive items compared to your entry-level items.
Got it.
Volume, on the other hand, is the physical reality of your business. It tracks the actual number of units moving off the shelf. Like, are you putting more physical boxes of detergent and bottles of mouthwash into consumer shopping carts?
And for most of the industry in 2026, the answer is a resounding no.
Exactly. Consumers are exhausted by inflation, so they are just buying less stuff.
Which makes that 4.3% volume growth from Church and Dwight look like an absolute anomaly. I mean, they're doing the exact opposite of their peers.
They really are.
Only a tiny fraction of their growth, that 1.5%, is coming from pricing actions. The vast majority of their growth is coming from the fact that people are physically buying more of their products.
Yes.
They aren't just squeezing their existing customer base for extra pennies to pad the balance sheet, right? They are actively expanding their customer base and driving higher physical consumption.
And that right there is the ultimate leading indicator of brand health. I mean, if you are growing through price hikes alone, you are playing a very dangerous game of chicken with the consumer.
Yeah, eventually they just break.
Right. Eventually you hit a ceiling where the consumer simply taps out and trades down to a generic store brand. But if you are growing through pure volume, it means your product is resonating, your marketing is working, and you are taking actual physical market share away from your competitors.
And we see that underlying health flow straight down into their profitability metrics too.
Oh, absolutely.
Their adjusted earnings per share, or EPS, came in at 89 cents, which neatly beat their internal outlook of 88 cents. But the metric that really caught my attention and where I want to push on the mechanics of how this business actually operates is the gross margin.
The gross margin bridge on this call was wild.
It was. They reported an adjusted gross margin of 45.4%, which is an expansion of 40 basis points year over year. But when you look at the gross margin bridge provided by the CFO, the underlying math required to achieve that 40 basis point expansion is incredibly complex.
It's some heavy lifting.
Management presented it very smoothly, but they were fighting a massive headwind.
They really were. And, the gross margin bridge is a standard part of an earnings call where the finance team walks investors through every single variable that either added to or subtracted from their profitability compared to the prior year. And you are right, the headwind they faced was severe.
Yeah, they reported a 400 basis point headwind to their gross margins.
Yeah.
And for our listeners who might not breathe basis points every day, 400 basis points equals a full 4% drag on their profit margins. That is a massive chunk of profitability just vaporizing.
Just gone.
And what caused it? The CFO cited inflation, tariffs, and transportation costs.
The usual suspects right now.
Right. Essentially, the fundamental costs of acquiring raw materials, manufacturing the products, and putting them on trucks to get to Walmart and Target just skyrocketed. Yeah. They absorbed a massive supply chain shock. To me, looking at these numbers, they basically took a 400-pound weight of inflation straight to the chest and still managed to jump higher.
That's a great way to put it.
Because they ended up positive by 40 basis points. I really want to understand the actual mechanics here. How do you mathematically offset a 4% drag and still come out ahead?
It requires a highly coordinated, multi-pronged approach, and it really highlights the operational leverage that Church & Dwight has built into their system.
Okay, lay it out for us.
So to offset that 400 basis point drag, they utilized 3 distinct internal mechanisms. The first was 150 basis points generated entirely from sheer productivity programs.
Okay, wait, what does that actually look like on the ground? Because when a CPG company says productivity programs, are they just, firing people, or is it deeper than that?
No, it is much deeper and usually much more structural. In manufacturing, productivity means wringing inefficiencies out of your global supply chain.
Like what, specifically?
Well, it might mean re-engineering the physical packaging of a product so that it requires, say, 10% less plastic.
Oh, sure.
Which not only saves on raw material costs, but it also makes the product lighter, which saves on shipping fuel.
That makes sense.
It also means optimizing the layout of a factory floor to increase the throughput of a production line, so you are producing more units per hour of labor. It involves procurement strategies too, like negotiating better long-term contracts for the base commodities you need, like the raw chemicals for a laundry detergent. So through pure operational discipline, they clawed back 150 basis points.
Okay, so that gets us 150, but we have a 400 basis point hole to fill. Where does the rest come from?
Right. So the second mechanism was 110 basis points generated from the recent acquisitions. Church & Dwight has been on a very targeted buying spree, acquiring brands like Hero, the premium acne patch company, and TheraBreath, the specialty mouthwash.
Right. I use TheraBreath. That's great.
It is. And these are not commodity products. Because they are highly differentiated premium brands, they naturally command much higher profit margins than, say, a standard box of baking soda.
Oh, I see.
So as these newly acquired high-margin products become a larger percentage of Church & Dwight's total overall sales mix, they naturally pull the company's average overall margin upward.
That makes perfect sense. It's a mix shift toward premium.
Exactly. And finally, the third mechanism was 180 basis points generated from that incredible volume and price mix combination we discussed earlier.
Let's break that down, because I think a lot of people understand how raising prices, the price mix part, helps margins. If it costs you $1 to make a product and you sell it for $2, your margin is 50%. If you raise the price to $2.50, your margin obviously goes up. That is intuitive.
Right.
But how does pure volume growth, just selling more units at the exact same price, actually expand your gross margin percentage?
That comes down to a concept called fixed cost absorption.
Okay.
Every single manufacturing facility has fixed costs. The rent on the factory building, the insurance, the baseline electricity to keep the lights on, the salaries of the plant managers. These costs exist whether you produce 1 bottle of detergent or 1 million bottles.
Right. You have to pay the rent either way?
Exactly. So if you only produce 1 bottle, that single bottle has to absorb 100% of the factory's fixed costs, meaning its profit margin is terrible. But as you increase your production volume and pump millions of bottles through that exact same factory, those fixed costs are spread out over a much larger number of units.
Oh, wow. So the cost to produce each individual incremental unit actually goes down.
Precisely. Because Church & Dwight drove that massive 4.3% increase in physical volume, They ran their factories way more efficiently. They absorbed their fixed overhead costs better than they did last year, which translated directly into 180 basis points of margin expansion.
So just to summarize the math for everyone, you take the 150 basis points from supply chain productivity, you add the 110 basis points from the premium acquisition mix, and you add the 180 basis points from the fixed cost absorption driven by volume.
Yep, that gives you 440 basis points of positive upward force. That completely overwhelms the 400 basis point downward drag of inflation and freight, leaving you with a net positive expansion of 40 basis points. I mean, that is a phenomenal piece of corporate engineering.
It really is. And the result of that engineering is not just some fancy accounting trick. It generates very real, tangible liquidity.
Yeah.
Which brings us to the cash flow metric you mentioned at the top.
Right.
Cash from operations in the first half of the year hit $462 million. That is an increase of 10.8% compared to the exact same period last year.
Nearly $500 million in operational cash flow in just 6 months.
Right. And in a high interest rate environment where borrowing money is incredibly expensive, the ability to organically throw off that much cash is a massive strategic advantage.
It's huge.
It gives them the internal ammunition they need to fund their own acquisitions, invest in marketing, and keep this entire growth cycle spinning without having to go beg the debt markets.
So, okay, the financial architecture looks incredibly robust. They are growing the top line entirely through volume, they're expanding margins despite brutal inflation, and they are generating double-digit cash flow growth.
Ticks all the boxes.
It does. But as an investor, you can't just buy a spreadsheet. You're buying the underlying assets.
Right.
To understand if this financial performance is actually sustainable, we need to transition away from the corporate level and look directly at the specific brands driving these volumes on the grocery store shelves. And I think the most illuminating place to start that analysis is in the laundry aisle.
The laundry aisle in 2026 is an absolute bloodbath.
That is exactly what it sounded like in the transcript. Church & Dwight obviously owns Arm & Hammer laundry detergent, which is, one of their foundational heritage brands.
Yeah.
During the call, the CEO, Rick Durker, provided some incredibly specific, granular data on just how brutal the competitive environment is right now.
It is arguably the most aggressive promotional environment we have seen in years. Usually in the consumer staples world, when baseline commodity prices stay high, meaning the chemicals and plastics needed to make detergent are expensive, the major players will mutually back off on promotions.
They call it truce.
Exactly. They stop offering discounts because they all need to protect their profit margins. But that rational behavior is completely breaking down right now. Deirdre noted that one of their primary competitors, Henkel, which is the massive conglomerate behind brands like Persil and all, they increased their promotional activity by a staggering 1,100 basis points.
Stop. I really want to emphasize what that number means in the real world for our listeners. 1,100 basis points is 11%.
Right.
Henkel increased their promotional spend by an amount equal to 11% of their sales. In the low-margin world of CPG, that is an astronomical sum of money to throw at discounting.
It's practically unheard of.
It translates to flooding the market with digital coupons, paying massive slotting fees to secure giant end cap displays at the front of grocery stores, and just slashing the everyday shelf price to the absolute bone. They are essentially buying market share by giving the product away at a massive discount.
Yeah.
And it wasn't just Henkel. Procter & Gamble, the undisputed titan of the aisle with Tide, they increased their promotional spend by 200 basis points. So the two biggest players in this space are in this aggressive race to the bottom to win over the cash-strapped consumer.
It is a classic price war. And, the most telling data point of the entire quarter is how Church & Dwight responded to it.
This is wild.
They didn't engage. While Henkel was up 1,100 basis points and P&G was up 200 basis points, Church & Dwight actually reduced their promotional spend by 300 basis points.
So they just completely ignored the price war.
Completely ignored it. I mean, they pulled back.
While everyone else in the aisle is screaming, sale, 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 Church, and Dwight just quietly stepped away from the discount bin. If you look at traditional economic theory, if all your competitors slash their prices and you maintain yours, your sales volume should just plummet.
Right, you should lose massive share.
But that isn't what happened. Despite pulling back on promotions by 300 basis points, Arm & Hammer laundry detergent consumption actually grew by 1%. They held their ground and even grew slightly while spending less money to do it.
If we connect this to the bigger picture, this is a perfect illustration of the behavioral economics of the value tier brand. The CEO, Rick Durker, spent a lot of time discussing the specific psychology of the Arm & Hammer customer.
Okay, what is that psychology?
Well, Arm & Hammer naturally sits at the intersection of high quality and value pricing. It is not the most expensive premium brand, but it has decades of heritage and trust. When a consumer is feeling this severe pinch of inflation, they look for ways to cut their grocery bill. So they might decide to downgrade from a premium, expensive brand like Tide down to Arm & Hammer.
Ah, the trade-down effect.
Exactly. But because Arm & Hammer already has that baseline inherent reputation for being affordable and effective, Church & Dwight doesn't have to bribe that consumer with an extra $2 off coupon to close the sale. The brand's everyday low price is already the solution the consumer is looking for.
So while competitors are allegedly taking any tariff refunds they get and immediately dumping them into aggressive discounts just to desperately defend their market share, Church & Dwight just stands there.
Just stands there.
They rely on their historical brand equity, they hold the line on pricing, and most importantly, they keep their profit margins completely intact. They are letting Henkel and P&G destroy their own margins to fight over the highly elastic, price-sensitive shoppers, while Church & Dwight quietly collects the consumers who are structurally trading down to the value tier.
It is a massive show of strength, a huge flex of pricing power.
Seriously, but laundry isn't the only category where Arm & Hammer is dominating. We have to talk about the cat litter numbers. The pet care segment is fascinating right now. Arm & Hammer cat litter consumption grew by 7.5% in the quarter. Huge. Because of that volume surge, they gained 0.8 share points, pushing them to a 24.5% total market share. Almost a quarter of the entire cat litter market in the United States belongs to them.
And this wasn't just, a macroeconomic accident or a general trend toward pet ownership. This 7.5% growth was driven by a very specific, calculated piece of product innovation.
Right.
Earlier in the year, they launched a new product line called Dual Defense with Microbond Clumping Litter. Now, cat litter is a category that consumers generally do not want to think deeply about.
No, absolutely not.
It is a strict utility purchase. You just want it to clump well and not smell up your house. But bringing in an additive like Microband, which is an incredibly well-known, trusted antimicrobial brand, is a brilliant piece of cross-branding.
It creates instant credibility. By partnering with an ingredient brand like Microband, they are signaling a level of clinical effectiveness that just elevates the product above standard clay litter.
Right.
And the pet care category is notoriously sticky. Consumers are highly resistant to changing their pet's food or litter once they find something that works, because the switching costs, in terms of the pet's reaction, can be highly unpleasant.
Oh, for sure. You don't want to mess with the cat's routine.
Exactly. So driving a 7.5% volume growth in this specific category means they are capturing a cohort of consumers who are likely to remain loyal for years to come.
Which provides an incredible stable foundation for the company. The laundry detergent and the cat litter are the traditional steady 80 cash cows of Church & Dwight. They generate the reliable cash flow we talked about earlier.
Yep.
But this leads us to the part of the underlying business story that I find the most compelling. I like to call it the acquisition flywheel.
This is the really fun part.
It is. This is where they take the cash generated by baking soda and cat litter, use it to acquire smaller, hyper-gross niche brands, and then absolutely strap a rocket to them. Let's start with TheraBreath.
TheraBreath is arguably one of the most successful CPG acquisitions of the last decade. It is a masterclass in scaling a brand. In this specific quarter, TheraBreath's mouthwash market share jumped an incredible 4.5 points, hitting 25.3% of the total market.
It's just massive growth.
They are now firmly entrenched as the number 2 player in the mouthwash category, sitting less than 1,000 basis points behind the absolute legacy market leader, Listerine.
And the statistic that the CEO dropped regarding TheraBreath is what makes this story so explosive. He noted that TheraBreath's current household penetration is only 14%. And to understand why that matters, you have to compare it to the total mouthwash category, which has a household penetration of 65%.
This is a crucial concept for retail investors to grasp, this idea of total addressable market versus current penetration. That 65% number means that out of every 100 homes in America, 65 of them regularly purchase some form of mouthwash.
Right.
It is a highly penetrated, widely used category, but out of those 100 homes, only 14 are currently buying TheraBreath.
So, Despite being the number 2 player in the market and holding a 25% dollar share, they haven't even scratched the surface of the physical households available to them.
No, not even close.
They have massive white space to grow into. They don't even have to convince people to start using mouthwash, right? They just have to convince the 51 households who are currently buying a competitor to try TheraBreath once.
And because the brand equity and consumer loyalty for TheraBreath are so exceptionally strong, the major retailers are essentially rolling out the red carpet for them to expand. The CEO noted that they are now aggressively pushing TheraBreath into the toothpaste category.
Oh, this is such a cool detail.
Yeah, and despite only fully entering physical brick-and-mortar stores with their toothpaste a few months ago, they have already grabbed a full 1-point market share in the total toothpaste category.
Rick Durker actually had a great moment of candor on the call regarding this. He said, and I quote, "We never deserved the space that we got for TheraBreath toothpaste." What he meant by that is, if you are a brand new, unproven toothpaste, it is almost impossible to convince a Walmart or a Target buyer to give you premium shelf space at eye level. That space is fiercely guarded by Crest and Colgate.
You don't just walk in and ask for it.
Exactly. But because the TheraBreath mouthwash is selling with such phenomenal velocity, generating massive dollar per square foot returns for the retailers willingly handed over premium toothpaste shelf space just by association.
It is the ultimate brand halo effect in action. The retailer assumes that the rabid loyalty for the mouthwash will immediately transfer to the toothpaste, which mitigates their risk.
Right.
And the early data suggests the retailers were absolutely right to make that bet. And we are seeing Church and Dwight execute this exact same expansion playbook with another recent acquisition, Hero, the acne patch brand.
The Hero data is just as compelling. Hero is currently outpacing the growth of the entire acne patch category. And just like TheraBreath, when you look at the household penetration data, the runway for growth is massive. Hero's current household penetration sits at just 10%, while the total acne treatment category sits at 30%. They have an enormous opportunity just to drive trial of their core product, the hydrocolloid patch, in more homes. But following the exact same strategy they used with TheraBreath, they aren't stopping at the core product.
No, they are pushing further.
They are leveraging that intense brand love to expand into adjacent categories. Specifically, they are moving Hero into the facial cleanser market,
which fundamentally changes the economics of the brand. The facial cleanser market is a $650 million category in the U.S. alone. It represents roughly 30% of the entire acne care category.
This is such a brilliant strategic pivot. I mean, think about it. They start by acquiring a tiny, highly niche product, a little hydrocolloid patch that you put on a pimple maybe once or twice a month when you have a breakout. It's a low-frequency reactive purchase.
Right, you only buy it when you have a problem.
Yeah, exactly. But they use that highly effective patch to build fierce emotional customer loyalty. Once they have that trust, they introduce a daily facial cleanser. They've just successfully transitioned a customer from an occasional once-a-month purchase to a daily, highly recurring consumable.
There's cheater.
They drastically increase the lifetime value of that customer without having to spend a dime on new customer acquisition.
It is a textbook example of expanding your share of the consumer's wallet. And they are currently in the early stages of running this exact same playbook with their most recent acquisition, a brand called Miss Mouth.
Yes, Miss Mouth's Messy Eater Stain Treater. They just acquired this brand in June, right at the end of the quarter. For those who aren't familiar, it is a highly viral digital native product. It is currently the #1 stain remover brand on Amazon.
#1.
And the initial growth numbers they reported for it are frankly staggering. Consumption grew by over 50% in the quarter, and it rapidly gained 3.5 share points in the broader stain removal category.
And once again, we look at the white space. Household penetration for Miss Mouth is a mere 2.5% compared to 50% for the broader stain removal category. But the most revealing metric the CEO shared regarding Miss Mouth is its ACV.
Here's where it gets really interesting. I noticed that ACV metric too. It's at 35%. To me, when you understand what that means, that 35% figure is actually the most bullish piece of data in the entire earnings report.
Really? Because, I mean, why does that specific number stand out to you so strongly? 35% is objectively terrible when you compare it to the broader stain removal category average, which sits at around 80%.
Exactly. That is exactly why it's so bullish. It highlights the massive arbitrage opportunity Church and Dwight just bought.
Oh, I see where you're going with this.
So ACV stands for all commodity volume. It is a metric used in the CPG industry to measure a product's distribution footprint. It essentially calculates the total sales volume of the specific grocery stores where your product is physically on the shelf compared to the total sales volume of all grocery stores in the country.
Right.
So if you have an ACV of 100%, it means you have achieved total market saturation. Your product is available in every single major store a consumer might walk into.
Yep.
So Ms. Mouth has an ACV of only 35%. This means the vast majority of physical retail shoppers in America cannot even buy this product if they wanted to because it isn't on the shelf at their local store.
It's just not there.
This tells us exactly what Church & Dwight's M&A strategy is. They do not buy massive, mature brands that are already maxed out at 90% ACV because there is no room left to grow.
Yeah.
Instead, they buy a niche brand that has already proven it has product market fit by going organically viral on a platform like Amazon.
They use Amazon as a free testing ground.
Bingo. Once the brand proves it can sell, Church & Dwight buys it, and then they simply plug that brand into their massive pre-existing global retail distribution network. They take that 35% ACV, they leverage their decades-old relationships with the buyers at Walmart, Target, and Kroger, and they forcefully push that ACV toward the category average of 80%.
It completely removes the guesswork from the acquisition. They aren't hoping the product will resonate with consumers. They already have the Amazon sales data proving that it does. The only variable is distribution, and distribution is Church & Dwight's core competency.
All right.
It is a highly calculated arbitrage play on retail availability.
But, you know, in the spirit of a true objective deep dive, we cannot just talk about the home runs and the massive margin expansions. We have to look at the areas where the company is struggling.
Yeah.
And in this transcript, there was one glaring blemish, and it was clearly Batiste in the United States.
Yeah, Batiste is their premier dry shampoo brand.
Right.
During the Q&A portion of the call, an analyst from Brookshire, Edward Lewis, he specifically called this out, referring to it as a tricky spot in the portfolio.
Right.
The data shows that in the U.S., Batiste consumption grew by about 2%, but the overall dry shampoo category grew at 5.5%. As a direct result, Batiste actually lost 1.44 share points in the quarter.
So this is where I have to push back hard on the management team's optimism, because they tried to brush this off fairly quickly.
They did.
Wait, is this a structural crack in the armor? You have this operational juggernaut of a company that is flawlessly executing across laundry, pet care, and oral care. And yet, their premier flagship dry shampoo brand is actively losing market share in their most important home territory.
That's a fair point.
Are we seeing a fundamental shift here? Like, are competitors finally out innovating them, or has the Batiste brand just lost its resonance with the younger demographic?
It's a valid concern, and it raises a critical question about how investors should evaluate global brand health versus localized execution errors. The CEO, Rick Durker, was very quick to contextualize this loss as a tale of two cities.
Okay.
While the U.S. performance is undeniably lagging the broader category right now, Batiste internationally is growing at strong double digits. In fact, it is one of their primary drivers of total global growth.
Okay, so if it's growing at double digits internationally, that tells us the core product formulation isn't broken. The global consumer still wants the product. So what exactly is going wrong in the U.S. market?
It comes down to a highly technical concept called price pack architecture.
Price pack architecture, okay.
Yeah. When inflation hit, Church & Dwight, like everyone else, had to take pricing actions on Batiste. But it appears they miscalculated how the U.S. consumer would react to the specific size and price combinations they offered.
Oh, I see.
For example, if you raise the price of a standard 4-ounce can too high, the consumer might balk. If you try to force them into a larger, more expensive 6-ounce can to drive volume, they might switch to a cheaper competitor. Durker stated very clearly that they recognize they missed a step in optimizing this architecture for the U.S. consumer.
So it's a packaging and pricing matrix failure, not a brand failure.
Exactly. And more importantly, Durker outlined a very specific roadmap to fix it. They are currently overhauling their price pack architecture for the U.S. market, meaning they are recalibrating the sizes of the cans, introducing multi-packs, and adjusting the price points to better match consumer expectations.
Okay.
They also have a wave of new product innovation queued up for late this year and early next year to recapture momentum.
I suppose when you look at how flawlessly they are managing the rest of the massive portfolio, you have to give them a certain degree of benefit of the doubt that they can solve a localized mechanical pricing and packaging issue.
Right. They've earned that trust.
Especially when you see how well they're executing on their digital and global footprint.
The CFO noted that global e-commerce grew by 22.7% in the quarter and now makes up 25.5% of their total sales. Over a quarter of their entire business is happening online.
And international organic sales, driven heavily by brands like Batiste and TheraBreath, grew by 9.1%. So they are not solely reliant on the U.S. brick-and-mortar consumer holding up. They have achieved real, structural, geographic, and digital diversification.
Okay, so we have exhaustively covered the historical numbers, and we understand the specific brand momentum acting as a tailwind right now. The pivotal question for us as forward-looking investors is, what is management's specific playbook for the rest of the year?
Right, where are we going?
Exactly. How are they planning to steer this cash-generating machine through the back half of 2026?
This is where the earnings transcript transitions from a historical report card into a strategic roadmap for the future. And the tone from management was incredibly confident. Based on the strength of the first half, they issued full-year upgrades across almost every major metric.
Let's lay out the revised data for everyone. They officially raised their organic sales outlook for the full year to a range of 4% to 5%, which is a significant bump up from their previous guidance of 3% to 4%.
Huge bump.
They raised their adjusted EPS growth expectations to 6% to 8%, up from 5% to 8%. They raised their total cash flow expectations to $1.175 billion. And despite the inflation we discussed earlier, they expect gross margin expansion to be between 100 and 120 basis points for the full year.
But the most fascinating part of this guidance isn't just the raw numbers, it is how management is choosing to allocate the success.
Yeah, this was really interesting.
An analyst from Goldman Sachs, Bonnie Herzog, zeroed in on this dynamic during the Q&A. She pointed out a discrepancy that a lot of retail investors might have missed. She noted that while Church & Dwight significantly raised their top-line organic growth expectations and significantly raised their gross margin expectations, they only raised the bottom end of their EPS guidance.
No.
They kept the top end of the EPS range exactly the same.
Right. She essentially asked the fundamental question of capital allocation, which is, if you are generating all this extra revenue and your profit margins are expanding, why isn't all that extra cash dropping to the bottom line to instantly reward shareholders with a massive earnings beat?
And the CEO's response to that question reviews the entire operating philosophy of Church & Dwight. He essentially told her to look at their track record over the last decade. He explicitly stated that when the company over-delivers on the top line and generates surplus profit, their immediate instinct is not to hoard it for a quarterly EPS beat, but to spin that money directly back into the business.
He called it a virtuous cycle. Instead of letting all those unexpected profit beats flow to the bottom line just to artificially juice their earnings per share and make Wall Street analysts happy for a single quarter, they're actively pumping it back into customer-facing investments.
Yeah.
Specifically, they announced they're raising their marketing spend to 11% or more of total sales for the full year. And in Q3 specifically, they expect marketing to hit around 12% of sales.
In the CPG industry, 12% of sales dedicated to marketing is an incredibly aggressive posture.
It's massive.
It shows that they are essentially self-funding their own future market share grabs. They are taking the windfall profits from their margin expansion and using it to buy more advertisements for TheraBreath, more influencer campaigns for Hero, and more Amazon search placement for Miss Mouth.
If I am a retail investor holding this stock, this is exactly the kind of long-term stewardship I want to see. Do not give me an extra 2 cents of EPS today if it means sacrificing brand dominance tomorrow. Build the moat.
Build the moat, exactly.
And they aren't just dumping this money into traditional television commercials either. Durker specifically mentioned that they are pulling forward heavy investments into AI initiatives to scale their marketing and internal processes faster.
This connects directly to how Church & Dwight views its own competitive advantage. The CEO stated that their core competency as an organization is speed and agility. In a macroeconomic environment where consumer preferences shift rapidly and supply chains are constantly volatile, the company that can process data and adapt the fastest is the one that wins. Integrating AI into their marketing analytics allows them to identify emerging consumer trends, like the sudden virality of a stain remover on TikTok, and deploy capital against it faster than a massive, slow-moving conglomerate like P&G can react.
And speaking of volatility, we have to touch on the specific macroeconomic headwinds they modeled into their guidance. because they are not operating in a vacuum, and they were very transparent about the external pressures they are facing in the back half of the year.
Very transparent, yeah.
The CFO, Lee McChesney, noted that they are modeling for roughly $30 million in transitory cost pressures. This is primarily driven by elevated raw material costs, higher transportation fees, and various logistical premiums resulting from the ongoing conflict in the Middle East. They're basing this forecast on the assumption that crude oil will sit at around $90 a barrel.
Freight and global logistics are undeniably getting more expensive. But this brings us back to the margin mechanics we discussed earlier. Because their internal productivity programs are so robust, they noted that they are fully mitigating that $30 million headwind internally.
Just wiping it out.
Yeah. But McChesney also dropped a very interesting positive catalyst into the guidance. They are officially expecting a $15 million Phase 2 tariff refund to hit in the second half of the year.
So they have $30 million in bad news, which they're entirely offsetting with internal supply chain productivity, and they have $15 million in unexpected good news from the government.
Right.
And what are they going to do with that $15 million windfall? You guessed it, they are pumping it straight back into that virtuous cycle of marketing and brand investment. It is a relentless compounding machine.
It really is.
But, the most revealing part of their future strategy, and frankly, the part that ensures this growth engine doesn't stall out in 2027, was a major structural shift in how they are handling mergers and acquisitions, specifically in the international markets.
The structural shift in their M&A strategy is a critical development. This was brought up during a probing question from Steve Powers, an analyst at Deutsche Bank. Church & Dwight has been publicly stating their desire to acquire international brands for years, but the actual deal flow seemed sluggish. They didn't seem to be landing the big targets.
And the CEO, Rick Durker, was surprisingly honest about this failure. He bluntly admitted, quote, "I think we were busting our pick on it for a little while."
Yeah, very candid.
He explained that when they initially launched their international M&A push, they set it up as a centralized center of excellence. They hired a team of dedicated M&A professionals, likely based out of a corporate office in Europe somewhere, and tasked them with finding deals. But these M&A guys were acting totally independently from the actual on-the-ground local management teams who were running the day-to-day operations in those countries.
Which is a classic corporate failure mode. From an organizational psychology standpoint, a centralized M&A desk operating out of a skyscraper in London or New Jersey doesn't necessarily have their finger on the pulse of what the hottest, most viral local brand is in a specific regional market.
Of course not.
They are looking at spreadsheets, screening for financial metrics, and often missing the underlying cultural relevance of a brand. Furthermore, if the centralized team buys a brand and simply hands it over to the local country manager to run, there is no inherent ownership or buy-in from the local team.
Right, it's a forced marriage. So, recognizing this structural flaw, Durker said that 6 to 8 months ago, they completely inverted the model. They dismantled the centralized center of excellence approach and pushed the responsibility down the chain of command.
Which is brilliant.
It is. They made the local country managers, the teams, actually living and working on the ground in Australia, Southeast Asia, and Latin America, directly responsible for hunting down their own M&A targets. The CEO essentially told them, you have the right and the obligation to go find the brands you want to buy. What brands do you actually want to run?
It moves the entire concept of M&A from a theoretical financial exercise to a highly practical operational reality. By empowering the local teams, the people who actually understand the local consumers' daily habits, the regional regulatory environment, and the specific dynamics of the local grocery chains, the deal flow immediately exploded.
Wow.
Durker noted that they have filtered through 100 different international M&A deals in just the last 6 to 12 months since making this structural change.
That structural decentralization is so incredibly smart. It democratizes the hunt for the next hero or the next TheraBreath, multiplying their eyes and ears across the globe. But finding the brand is only step one. The real magic of Church & Dwight, and the reason they are able to confidently evaluate 100 deals a year, is their unparalleled ability to absorb a brand once they buy it.
Yes, the integration.
During the Q&A, they made a seemingly minor reference to their North American ERP system, their enterprise resource planning software, which they just recently upgraded.
It might sound like a dry IT topic, but the ERP system is the vital beating heart of any CPG company's acquisition strategy. An ERP system is the massive, complex software architecture that manages a company's entire day-to-day business activities.
It's the brain.
It handles the accounting, the procurement of raw materials, the project management, the risk compliance, and the intricate movements of the global supply chain. It is the central nervous system of the corporation.
And the CEO used the newly acquired Miss Mouth brand as the real-life test case for this newly upgraded nervous system. Remember, they just bought this company in early June. And Durker stated that Miss Mouth will be fully 100% integrated into Church and Dwight's massive corporate ERP system by the end of August.
To understand the magnitude of that statement, you have to understand the typical timeline in the consumer packaged goods industry. When a massive conglomerate buys a smaller brand, integrating the two companies usually takes a minimum of a year, and often much longer.
Yeah, it's notoriously slow.
You are dealing with completely different billing systems, incompatible warehouse protocols, different logistics providers, and different accounting standards. Usually, the corporate brain cannot effectively communicate with the newly acquired hand for 12 months because the digital nerve endings don't match up. To completely integrate a newly acquired brand into a global ERP system in under 90 days is a staggering logistical achievement.
It is the equivalent of a flawless central nervous system transplant. Because Church and Dwight has built this universal digital adapter, the moment they close the deal on Miss Mouth, their central corporate brain can instantly see real-time inventory levels in a regional warehouse in Ohio, automatically adjust their digital marketing spend on Amazon based on that inventory, and seamlessly route a new shipment to a Walmart distribution center, all without any manual data entry or system crashes.
It's seamless.
It proves that their back-office IT department is not just a standard corporate cost center, it is an actual weaponized frontline tool for their acquisition strategy. When they buy a brand, they do not fumble the handoff. They plug it directly into the mainframe, and that massive distribution flywheel we talked about earlier starts spinning at maximum velocity immediately.
Which brings us to the ultimate synthesis of all this data. Taking into account the sheer mechanics of their margin expansion, the highly calculated distribution arbitrage of their acquisitions, and the aggressive reinvestment strategy outlined in their guidance, what is the final, actionable verdict for the retail investor?
If we're looking at this through the strict talk tickers lens, the overall read on this quarter is definitively, unambiguously bullish. In a 2026 macroeconomic environment that is actively chewing up and spitting out legacy consumer companies, Church and Dwight is demonstrating a trifecta of operational excellence that is incredibly rare to find right now.
They're very rare.
They possess genuine pricing power, they are organically growing their physical sales volume, and they are mathematically expanding their gross margins simultaneously.
It is almost impossible to find a company moving all three of those specific metrics in a positive direction at the exact same time, especially when the fundamental input costs of freight and raw materials are highly volatile. Let's break this down into specific actionable intelligence for our listeners.
Okay, let's look at it from two distinct perspectives. First, how should you view this report if you already hold the stock in your portfolio?
If you are currently a long-term holder of Church and Dwight, this transcript should give you immense confidence in the conservative, disciplined nature of this management team. They are actively refusing to play the short-term Wall Street game.
Right.
They are not trying to artificially inflate their stock price today by passing every single extra dollar of unexpected profit down to the bottom line. By consciously holding the top end of their EPS guidance steady and aggressively funneling that surplus cash into 12% marketing spends and AI infrastructure, they are communicating their strategy very clearly. They are playing for 2027, 2028, and beyond.
I am the long game.
They are deepening the moat around their core brands and securing future market share while their competitors are distracted by promotional price wars. If you are a buy and hold investor, this is exactly the kind of capital stewardship you want to see.
So flip the perspective. What does this all mean if you are currently sitting on the sidelines? If you are a buyer looking at the consumer staples sector, trying to decide where to deploy capital in a turbulent market?
If you are considering initiating a position in the stock, you have to realize that Church & Dwight is no longer just a traditional soap and baking soda company. They are operating as an apex predator within the consumer staples ecosystem.
I love that term, apex predator.
It's true. They have realized that trying to invent the next billion-dollar brand from scratch inside a corporate R&D lab is slow, expensive, and highly risky. So they have outsourced the risk. They let the free market do the product testing for them.
Right.
They monitor Amazon search velocity, they track viral trends on social media, and they identify these $50 million to $100 million niche brands like Hero Patches or Miss Mouth Stain Treater that have already developed rabid, proven consumer loyalty. They acquire them, and then they leverage their ruthless retail distribution muscle and their lightning-fast ERP integration to force those brands into tens of thousands of physical stores, turning them into massive household names almost overnight.
They are effectively operating a self-funding, perpetual growth machine. They took a $30 million macro inflation shock straight to the chin without breaking a sweat, offsetting it entirely with internal supply chain productivity.
Yep.
They completely outmaneuvered massive rivals like Procter & Gamble and Henkel in a brutal laundry price war by simply refusing to engage in margin-destroying discounts, relying instead on the inherent value of the Arm & Hammer brand. They are empirically proving that their evergreen model, which is this corporate philosophy that targets consistent, steady growth regardless of the external economic weather, is incredibly resilient.
They are executing at an elite level across every single vertical of the business: supply chain optimization, behavioral marketing, retail distribution, and decentralized M&A.
Which brings me to a final thought for you, the listener, to mull over as we wrap up this analysis. At the very beginning of the show, we talked about the pervasive narrative that consumer staples are boring, safe.
Beige. The paint drying.
Right, the paint drying. We naturally tend to view a legacy company like Church & Dwight as a sleepy, slow-moving maker of baking soda that has been around for over a century. But look at the actual mechanics of what they are doing in 2026. They are utilizing advanced, upgraded ERP systems to instantly absorb digital native, viral Amazon brands in under 90 days.
Fast and aggressive.
They are heavily integrating artificial intelligence to scale their internal analytics and marketing faster than their legacy competitors. They have completely decentralized their global M&A strategy to empower local managers to hunt down hyperlocal viral trends across the planet. So the provocative question you have to ask yourself as an investor is this: is Church & Dwight actually operating more like a high-tech platform company, an agile, data-driven aggregator of viral IP that just happens to be disguised in the boring clothes of a consumer staples brand?
It is a deeply fascinating framework to apply to them. They aren't just manufacturing and selling soap anymore. They are running a highly optimized physical algorithm for brand scaling.
And when you view it through that lens, that sleepy grocery store aisle suddenly looks a lot more exciting. We want to thank you for joining us on this deep dive. The next time you are standing in your bathroom or walking through your laundry room, take a close look at the specific brands sitting on your shelf. If it is Arm & Hammer, TheraBreath, Batiste, or Hero, we hope you can now look at those everyday items through this new financial lens and clearly see the absolute machine operating behind them. Until next time, keep unpacking the data.